Good morning, YouTube, and good morning, Theta Daddies. Welcome to another video where today we're going to be talking about a very important topic, and that's how you're learning options the wrong way. Or probably did, and hopefully you already know, but if not, we're going to cover today what the right way to learn options is and why. So, number one, we're going to talk about a little story here first, story time. You can fast forward if you hate stories, but I just wanted to talk about why I know y'all learn options the wrong way. That's because every single person I've ever spoken to ever has bought an option long before they've ever sold it. So recently I was talking to a buddy of mine, and he was telling me all about how he's selling options because he knows I've told him many times, like, yeah, I sell options, and I'm always very clear that I sell options, not buy them. And he goes, yeah, I'm playing with options. I go, oh, are you buying or selling? And he goes, yeah, I'm selling options. You know, I buy them and then I sell them. And I'm like, oh, what are you selling options on? He goes, oh, well, I'm selling them on SPY. And I go, oh, okay. And in the back of my mind, I'm like, well, then you're dealing with a pretty decent sized portfolio, because if you want to sell a single contract on SPY and make any amount of money, as you can see by the chart here today, you're spending at least, or having at least $55,000 tied up in order to do that. And so I was like, oh, that's cool. Tell me a little bit more. And it's like, oh yeah, you know, I bought this option for a few $100s, and then I sold it back when it went up by X%. I'm like, oh, okay. You're not selling options. You're buying options. And when we're talking about buying and selling, we're talking about the transaction. What side of the transaction are you on? If you're on the buy side, even if you sell that option back, that was a bought option, right? And that, unfortunately, is just not the right way to learn, in my opinion. And the reason why is real simple. You're going to lose, or you're highly likely going to lose. And if you don't, you might have learned the wrong thing, unfortunately. Success is actually a big trap when it comes to successfully buying options and coming out ahead. And we're going to talk about why here by showing you a little screen that I think will clear it up pretty quickly. So this is the SPY option chain on Fidelity. I like Fidelity because it actually it lays it out pretty nicely here. You can put a whole bunch of other columns in here with the Greeks, Delta, Gamma, Theta, Vega. Most people are really looking at Delta the most. And you'll see that right now, this is based off of yesterday's trading volume. So obviously the price right now is 558 or whatever. Yesterday was at 563.51 is where we ended. And so an at the money call, which means, or option in general, means that at that price, that's the closest that you can sell an option to. So again, at the money means the price is basically the same as the strike price. So let's do a little experiment here and just click on the buy option for an at the money 564. Again, it's from yesterday, so the pricing is going to be a little bit off. And if we look at the chart on the right side, at least it's my right, hopefully it's your right, I'm realizing I'm blocking it, so let's move me out of the way for a second here. And what do you see right there? Well, the max gain is unlimited. Oh man, that's hot. I love that. I love unlimited gains. For sure, that's going to happen to me. But the max loss is only the cost of the option. So I can only lose $489. That seems pretty good, right? Low risk, super high reward. Sure. But what's the chances of finding that profit? Any profit, not like unlimited profit, any profit. And the probability is 27%. They tell you right there. They go, yeah, you maybe have a 1 in 4 chance of making money on this. That all of a sudden doesn't sound quite as sexy to me. That is a big roll of the die, and you're hoping that if you roll a bunch of dice that you get the exact number you're looking for. It seems questionable to me. So let's look one more time at the other side of the equation. To delete that real quick, let's sell the option, and we make a little bit less money potentially. We're capped at 486. But our estimated max loss is unlimited. Oh no, that's not good. I don't want to go broke, do you? Well, no. And chances are you're not going to, because unlimited loss is kind of a misnomer, right? It implies that there's a probability of some sort, which I guess technically there is, infinity is, or infinitesimally small is a probability. But it would require on SPY the entirety of the economic system globally to collapse for you to have an unlimited loss. And actually, unlimited loss, the most you can actually lose is the amount of money that you're putting up for buying the underlying. So we'll talk about that in a second. But basically, it says unlimited, but look at this. The profitability or the probability of profitability is the inverse, almost, minus the difference of the fee of the trade, 71% chance. Okay, so now you're telling me that I have a 70% chance to make almost $500. All of a sudden, that seems a little bit better to me, because let's go back for a second and look once again at the buy side and notice there's some other details to consider. That is, if you want to break even on this trade where you're selling a 564 strike option, you need to actually have price movement to over 568, almost 569. Nice. That's going to be tough, because that's like a percent movement almost of the price of SPY. And SPY often does not move a percent. Now, okay, right now it does in the current administration. So maybe we got to think about this in terms of a normal operating environment. However, 1% is a big move. Even today, it's not super common that we're moving a percent every day. So the chance of breaking even here means that, and that number is real small, sorry about that, but what that means is we need to see a significant increase from our strike that we sold at. Now that means if we take out the probability that we're seeing here, and which has changed, by the way, to 28% for whatever reason, I think it's important to remember that if you just do a coin flip of above 564 or below, well, it seems like it's a 50-50. But the fact is, by default, it's less than 50-50 because you have the required movement to get not only in the money, you're in the money at 564, but you need to get well above that number to break even, just to account for the cost that you paid for the contract, which means that not only do you need to get to 568.89, add another $500 to that, or $5 in the case of the individual stock price, to equal the profit you're guaranteed by selling it. So we saw that let's just use $5 as the example. So if we were going to make $500 selling the option, we would have to be at 574 to be on par with selling the option. So now all of a sudden we go like, oh, wow, we have to move 2% almost to exceed the profit that we're guaranteeing ourselves by selling it. Now, we'll once again go back to the other side of the equation. If we were to sell this, right, and we're back at 71%, apparently, it seems to move a little bit back and forth. The unlimited max loss, what that means is if the underlying, which in this case is SPY, were to go to zero. So, of course, if you're selling the call, that means that you already have the shares, right? $5,000 or $56,400 worth of shares that you're going to sell. And with that in mind, your risk is the stock going down. But here's where we go back to my golden rule as a Theta Daddy, which is if you're an investor, and you're not gambling, but you're an investor, that means that you have a belief in that which you're selling, or investing in, I should say. And by having a belief in it, what you're saying is, long term, I believe that the stock will continue to go up. I don't think it'll go to zero. Now, on SPY especially, it seems highly unlikely that that's going to go to zero, because at that point, we've gone beyond economic collapse, beyond the Great Depression. The United States probably doesn't exist in the form that it does today, because it's an equity that tracks the entire market, right? S&P 500 tracker. So highly unlikely it's going to go to zero. Could it go down? Yeah. In fact, it's red right now. It's going to go down probably today as we're getting into the trading session here shortly. And pre-market is down at 558 as we were just looking on Robinhood Legend, right? So if you consider all that, your risk is for sure that the stock goes down. However, you can keep selling calls on it. And by selling calls on it, you lower your cost basis. So as an example, if I were to sell this option at 564 for $5, my cost basis by receiving that $500 in premium has just dropped by $5 on a per share basis. So now my cost basis is actually $5.59, which if this was a daily, it's a weekly that I'm looking at, but if it was a daily, well, that would mean that, which it wouldn't be, but if it was, it would mean that I'm still green. If you look at a cost basis perspective, I'm actually still green on that trade by having sold the option. Whereas the call side, let's see what would have happened if you had bought that call. You're at $0 right now. You're zero. That would be a real outcome right now of that stock, that option that you sold is worth $0. But on the call side selling it, we're happy. We made max profit regardless. Well, actually, we didn't make max profit. We got our profit guaranteed regardless. So what am I on? I'm on the sell, right? Okay, perfect. If you look, no matter what, we make $486. But wait, there's more. If you look at what your cost basis is of the underlying when you bought it, you'll probably have a max profit well above that number should the shares get assigned and called away. And what that means is if you finish in the money, right? So let's say that we did finish at like 568, or it doesn't matter. What if we finished at 600? You will have made max profit of this 486 plus the value of the shares at 5,000 or 56,400, because it's obviously 100 shares that you're selling, minus whatever your cost basis is. So let's just say that you sold them at or bought them at $500 a share. So that would mean that to sell a contract, you have $50,000 of a cost basis on those shares, and you're selling it for 56,400 plus the $500 from selling the option, the contract itself. That means that your actual profit is $6,886. That seems pretty good to me. With the flip side being like, oh no, you still own SPY if it doesn't get called away, which is also great. Then you could just sell the option again and either continue to lower your cost basis, or just if you're accounting for it transactionally, well, then you just walk away with more money, right? So this is why I think that it is much better to learn selling options than buying them to start. It does require some more capital up front, but the real risk is much lower. And then what you may find is you may never buy an option, which brings me to my next point. That is the people who run these systems, Fidelity, Robinhood, whoever, the markets in general, they don't want you to learn that way. What benefit is it to them if you learn to sell options versus buying options? In fact, we are essentially, by selling options, competing with the big dogs of the world who are primarily selling options. And that's because they know, just as now you know, that this is a much better way to guarantee your profit than the lower probability of buying a call. And now let's look at one other example here, and that is instead of 564, what if you wanted to buy an option, and this is a popular one here, at 570, okay? Now, all of a sudden we're like, this is cheap. This is a cheap option. 225, I can buy a bunch of these instead of the 564. Yeah, you could, but look what happens at the probability of profit. It's now down to 22%. And that's not a mistake. That's how it works, right? Not only do you need to get further than the 568 break even, now you have to get to 572 to even begin to make any return on your money. It requires a bigger percent movement of the stock. So unless you have a very strong conviction that this is going to happen, you're risking some amount of capital for very little return. Whereas the person selling that option, well, let's look at that. Sell. Probability of profit has gone up 77%. Now it's a smaller number, because there's a lower chance that you're going to have the shares called away because it's a lower probability of the stock moving that much. And we can look at that, right? We can actually look at what is the implied movement of the stock, which we'll get into in another video since that is a little bit deeper than I want to go here today. But you can keep going further and further out. So if we were to say like, hey, we're going to look from 560 to 650. It's going to be a big chart. And we scroll down to like 600 by the end of the week. Wow. There's actually a lot of people who are trying to buy this stock at that price. And that's because nobody's selling it because it's so far out and it doesn't make any money, right? So again, it would only cost you $2 if you could get it. And in that case, somebody buying at that price is actually making they're not actually betting that it's going to go in the money, as the probability is 1%. All they're really hoping for is by the end of the week, the value of that they can sell it back for is way higher, right? So that could be just a few people who've got 10,000 contracts at a couple bucks, which is actually not that much money, but the probability of them making anything is low. However, if the stock moves by, 10 points and does end up at 570, that could change this value from 2 cents to 10 cents. And then they have a huge increase on the money that they made. So, but again, the general idea of buying and selling options is very gambly in nature, and you may never see any return on it. In fact, if you were to just look at where we're at right now, based off of yesterday's close price, you're not seeing $1 of improvement. You would need it to go up. So at best, you have 50% of making any profit, right? Again, lower. At best, you have probably 45% if you take out the cost of the contract. I'm sure there's an exact number there. I'm not sure what it is. I guess we could just use their 27%. It's a lower percent than 50%, lower than a coin flip. But if you sell the option, you guaranteed made profit. And to me, that sounds like a much better way to long-term generate returns that you can count on, that are consistent. Will you miss out on big spikes here and there? Yeah, for sure. You will. I will tell you right now, there will be times that somebody who sold a call, that's why this works, right? That's why people like this, because the allure of making a lotto ticket type play and getting thousands upon thousands of dollars from a big spike is pretty sexy. But what did you really lose if you sold an option, guaranteed yourself some profit, the price went up, whatever, and you buy back in at whatever the new price is and do it again? It doesn't matter. Your share count may go down, yeah, but your return is still real. Nothing changed there. So start wrapping your mind around that a little bit. And if it makes sense to you, maybe come check us out at the Theta Daddies. You can check out my Discord below. We've got a lot of people who are having a lot of success already. We've just passed 40 members yesterday, which is super exciting to me. And we've got a great little community going here that is really interested in guaranteeing profit. And I believe starting to learn how to sell options the right way instead of buying options and risking a lot every day. The most common response that we're seeing right now is, I've only had bad experiences with options, because they bought them. Of course you're 1 in 4 people don't have a bad experience the first time, but then 1 in 8 people, or I don't know, whatever the probability is that goes down every time you make a subsequent trade. Maybe it's 1 in 16 people at that point, right? I forget how that probability works. I should know this. Has a second bad experience, and then it goes down and down and down if you're just playing the numbers by itself. And the fact is, most people who start selling options don't actually know what they're doing. So why don't you learn by selling? And if you do that, I think you'll have a much better time. That's it for today. Thanks for watching. I'll see you in the next video.